because they're circulating it, that means we have inflation, and our GDP is okay, but it's not great. So with debt at record levels and climbing, these are buy and hold signals. All right, so that's the political climate with your federal budget update for Canada. And now moving into GDP for our economic health across US and Canada. And we're starting with Canada. So Stats Canada, gross domestic product by industry, real GDP up 0.2% in January. That's the closest that they've had. And it's above pre-pandemic restrictions. This is a fantastic little, look at this. So billions of change, 2012 dollars, all industry. Now they just chose 2012. What they do is that allows them to basically look at monies equally without the influence of inflation on them, so that you can actually see is it actually comparative. And so we can see right here. Look at that line. Okay, we were doing great. Obviously plummeted, and we are literally above. I added that line, by the way, and it is straight. So at any rate, we are above those pre-pandemic government restriction shutdowns. This is very, very good news for sure from an economic recovery. And of course, the economic output is a leading indicator that forecasts, one of many indicators that forecasts our rents and where they're going to go and our property prices. So this is something to definitely watch out for. Here's the actual numbers, which in case you wanted to see it, February 2020 to, I won't even say it, the amount there, and then you can see that by November 2021 we'd already surpassed basically the beginning of that where we were at the height prior to the pandemic related government imposed shutdowns. So we're well on our way in terms of trajectory. That's always very good. And then what it means, because it's a leading indicator, we're expecting a long, slow, expansionary period in our real estate cycle. And by long, I mean something like about 10 years. So we are on the right side of up. We can see the possibilities with our economic recovery at this time. Why do I say at this time? You definitely want to be staying tuned. There are some measures and some pieces that are at play that will have an impact on how successful this economic recovery is. That said, nothing's falling off the cliff at the moment, so just hang on and stick with us. We got you. That was not a cliffhanger. I know I address it later, so don't worry. Just stick with me. So the Epic Times, they came out with the U.S. economy. Oh gosh. Here we go. So the U.S. economy is likely to dodge recession despite the Fed Reserve's the federal government tightening goal, and this is Goldman Sachs. So U.S. GDP in 2022, Goldman Sachs is predicting it will be annualized up 3%. So that's pretty good. That's the second fastest pace in 17 years, following 2021's 5.7. But remember, that's called net GDP. 2020 was way down. So of course, when you have a percentage up, it's way up. So that's just net. So no big whoop. But now the U.S. economy, similarly to Canada's, is like back on track pre-pandemic levels. So a 3% growth rate is actually quite high. It's pretty good. And in fact, you don't want GDP growth rates much higher than, well, at 5, it starts to be unstable. So that's just something to keep in mind. Okay, so they're also saying, Goldman Sachs is saying that 2022 home price gains are expected to be 8.7% compared to 2020's record gain of 19%. And at the Real Estate Wealth Lab, we wholeheartedly agree. That is still growth, though. So the good news is that we agree we are going to see more modest, but still growth. And 8.7 versus 19%, that's still good. That is great. Is it not? It's still higher than inflation, about there, the actual inflation. So that's good. The bad news is that the impact of the measures to deflate inflation are coming. And these include some form of recession. And that typically lags about 1.5 to 2 years from the moment that those measures to deflate inflation start to take hold. So this is why I say, yes, both Canada and the U.S. are in a great trajectory with their economic outputs. However, we will be seeing some form of a recession in the next few years because of how all of these indicators work together. But because there's dozens of indicators that we look at in the real estate cycle formula, that those other components have enough weight that they're still pushing and driving this slow, long-term, modest, expansionary period ahead for real estate. So stick with us, stay tuned, because there's a lot to unpack. I think I already did this one. Is a recession coming in 2022 or 2023? Oh, no, I didn't. This is another one. So inverted yield curves. Who here has heard of an inverted yield curve? Pop it in the chat. Yes, I hear so nods. Yes, Hugh, perfect, awesome. Okay, great. So there's a lot of analysis that actually goes behind calculating an inverted yield curve. But and I've done lots of research on it in the past. I'm not going into it right now. A lot of economists rely on that as a measure to indicate a potential recession. So it is one of those indicators. And the last time that we had an inverted yield curve, it was in when did I go sailing in Greece? It was in 2018, and I remember doing an analysis from a hotel in Greece in an earthquake about inverted yield curves, because it was very important. Everyone, yes, Greece, and it was so important because people were thinking, oh my gosh, this is a recession is coming. I'm like, you know what? In fact, it's not. It can be. So when you hear, why am I saying this? When you hear this in the news or on the headlines, oh my gosh, an inverted yield curve means recession. It doesn't necessarily. It is literally just one potential indicator that could suggest that. So others say wait, and maybe not. So there we are. What you need to know here, I love this, the no opinion with regard to the inverted yield curve is not creating a recession right away. They're saying that the businesses they've got excess demand, low inventories, they've got lots of pricing power, they've got all this cash on their corporate balance sheets from the last few years to some extent, some of them, and they've got financing and ability to expand. Now, these businesses are where, this is where the pedal meets the metal, and there's more room to run. So based on these individuals, now this is all subjective economists with Goldman Sachs and above, and I should say, and peers, that they said that their individual subjective recession probabilities are in 2022, 5%. So what does that indicate? The yield curve is not necessarily the only indicator. 2023, 10 to 15%. 2024, 30% probability of recession, and 2025, about 50% of a recession. Now, this is where it's going to be really important to stay with us and to watch this real estate cycle formula unfold, because there's measures that are occurring over here to dial down inflation, increase interest rates, and all these things, and they all have different lagging time frames that overlap and compress and all of these things. We've got to watch this very carefully, but there will be some form of a softening in the economy, and it's just natural economics, which we are going to get into in our inflation section coming up. So we've had a life jacket economy for the last 2 years. What do I mean by that? Government spending. They printed a whole lot of money, injected it into the economy at a time where we were not producing very much, and our economic output was down. That means, and it creates inflation. Now, what happens is that there's a place where it's going to deflate, because we need to deflate inflation. So interest rates are going up, and an outcome of that is, so there's basically two ways to deflate inflation, and that is through interest rates going up and jobs going down. So naturally, this economy that's so buoyed is going to go down. But I want to make sure at this point, and I'm going to keep you in the loop for all of it, is it's not likely to burst, but we will see a little bit of some deflation. So what do? Inflation plus crises. Now, I want to get this off my chest. So crises is the plural of crisis. So it is not a spelling error. It is intentional. So I just wanted to get that out there because there are multiple crises out everywhere. There's a crisis here and a crisis there, crisis everywhere. So because we have multiple of them on different fronts, when you have inflation and crises, you have two things that are really important for you. And I will have this come up a couple more times. What you need to know is inflation is here for a lot longer than most are letting on. It is a buy hold signal, as real estate is one of the most stable assets during turbulent times. And it's also one of the best performers in inflationary times. And typically it outpaces inflation, even if it's just a little bit, but it sometimes goes pretty big. And we're in both. Would you not agree? Are we in turbulent and inflationary times? Ultimately, those are double buy signals. Now, we got to come back to this because there's more about inflation. But here's where we are when we plot the GDP for Canada and the US on the real estate cycle formula. They're both, trending upwards with, an eye and an ear and listening for a potential softening again in the next little while. So jobs. Job is another leading indicator that helps us more accurately forecast rents and real estate prices. So we want to be keeping tabs on this. So the Financial Times, starting with the U.S. first this time, the Financial Times says the U.S. economy gained 431,000 jobs in March as the tight labor market persists. So this is good. Employment is up, unemployment is down, and unemployment has actually gone down to the lowest level since before the pandemic. The government imposed restrictions in response to the pandemic. So as a result, this is moving in a good direction. It's a hold, it's buy signals. We don't need to dive into that too much. Ladders, this was really interesting. The company that I think they do recruiting or something, but they put this whole thing together, a study, if you will. And they do recruiting for, I think, jobs that are over 100K, primarily in the U.S. And so these cities have the most high-paying jobs, and remote work beats them all. Now, there's a little teaser in here for us as real estate investors that we need to be way more strategic when this kind of information shows up, and I'll tell you how. So remote workers, I'll just move on. So cities here, in order of the most professional jobs available. Look at remote working is number one for professional jobs. Professional jobs are helpful for us depending on, who our tenant profile is, but they generally will rent nice apartments. They contribute to increasing the value of properties in a particular area. So we want to be paying attention to them. Number two, San Francisco, New York. You can read down the list, down all the way down to Austin, Texas. So all of these locations may be something that you would want to consider doing some more diligence on, maybe buy and hold, but we're going to unpack remote working in just a second. Because this is the cities with the fastest growing number of professional jobs. So this was with the most professional jobs. This is the fastest growing. Take a look at this list. So remote workers up 453%. Then we've got Rochester, St. John, New Brunswick, Quebec, Calgary, Washington, etc. But we're going to unpack remote a little bit because what it means is that remote jobs is winning. They're the most and the fastest growing markets. So when we come and think about it strategically as real estate investors, we have to look at it differently. We always want to go where people are moving, where the jobs are and where people are. But now we've got this disconnect. The jobs and the people, it's not the same. Because previously one might have considered, okay, well, you got GDP and jobs, so the people move there. That is not the case anymore. And that's why we at the Real Estate Wealth Lab are completely different, because we look at these individual indicators completely independently and then reverse engineer it to see what's actually going to happen based on their weighted impact. So in other words, in English, we're looking at populations first. Because look at this number of remote workers increasing. 400, this is just the professional jobs, 453%, which is an incredible number of increasing. And that means that there's people who have a job, they're remote. I've got this job. And they just go somewhere else. So what do you think that does to your economy? We can't look at cities the same way as before, because that economic activity goes with the individual, not the job site, not the location. So I hope that lands for you. This is really important. And we want you to do, so when you're considering exactly where you're going to invest, like, well, where would a remote worker, if this is my demographic, where would they go? A lot of them are moving to the Sun Belt. Where do they want to, like, we have to get into this psychology. Where do they want to live? And maybe some of them want to be global. And we'll be talking about global investing just a little later on. So when we complete our homework and our diligence, we want to be looking at all of these kinds of leading indicators, and combined with other indicators. These could be bias signals, but what it means for sure is that it's not the same as it used to be. You don't go just run into Rochester necessarily, because those that might not just be, I'm not saying that Rochester is bad, just we want to be looking at it differently. So when it comes to Canada, Stats Can, they basically said that this is their monthly update, their economic dashboard. GDP is continuing to expand, and this is again that third month, we saw it earlier, the third month above pre-pandemic levels. Employment is strengthening, and similarly to the US, unemployment has fallen to a record low. But for those of you who are hanging out with us at Rule back in January, actually, yeah, it was January. We already knew this, but at any rate, we debunked a few little theories out there, didn't we? Had a good time doing it too. So Canada employment 2022 in March was 4%. And I just want to let you know, so, oh yeah, I've got that here. Yeah, you can see it. Right, so March 2022, employment is now 4%. Did you know that a benchmark, some people consider a benchmark employment rate 6%. That means that 4% is above benchmark. It's better than. So that's interesting. Just something to keep in mind. So in other words, the employment situation in Canada is in good stead. So now again, we're plotting our jobs, Canada and the US, on our real estate cycle formula, and they're headed up in the right direction. Again, those impact our rental markets and our property markets upwards of 7 years down the road, even 10, which is what we were talking about most lately. People. So in Better Dwelling, Canada just saw the biggest Q4 of residents permanently leaving since the 1970s. This is wild. People don't leave Canada on the regs, and they certainly don't leave in December. Wow. So that's very unusual. 16,901 immigrants, meaning people leaving Canada, which is up 215% quarter over quarter. That's 56% you left at the end of November. That's right, Catherine. A lot of people, yeah, man. Things happened at the end of November. So that's a very good point. Thanks for pointing that out. See, connecting the dots, there were some policies that were implemented November 30th, travel bans and whatnot, that a lot of people might have just said, hey, I'm out. So if Canadians leave in higher volumes for sustained periods, it warrants a deep dive. What does that actually mean? So if there is a trend here, if this is consistent and more Canadians are in fact leaving, because that's just one quarter, it's still high, 55%, it's still high, but we don't know. We don't have the data yet. So we do need to stay tuned. We do need to watch it. Don't worry, we gotcha. But this consequences of it could be, if it is a trend indeed, is that it could, well, it certainly already is reducing Canada's net population. I mean, 17,000 people left, so that net population is down. But more importantly, it could have a bigger impact if it's a trend. And then secondly, it may actually have, how do I put this? I don't know. Like, have you ever been somewhere and somebody's like, oh, you know what, that's okay, but I'd rather, it's like only so-so. Well, you don't want to be on that train. You want people to go where the fun is, and like this new restaurant is hip and cool and that bar's out. Well, you know what? That might be happening here. So if people are leaving Canada, that's a signal to immigrants to go and reevaluate where they thought that they might be going to come and eat and hang out and live and play. And so it may reduce the desirability and the ability to attract immigrants. And it may turn to other countries instead of Canada. And I'm going to show you some data later that suggests that that's not necessarily that it's already happening, but it's certainly something to take stock of, given all the options out there. So a declining population is not usually a good sign for rental and property prices. You do need to stay tuned. But what this does signal is certainly not a run out and go and buy a whole bunch of properties. We need to understand, but this is just one indicator. That doesn't mean don't buy. This is one macro indicator, but it certainly doesn't imply that. So we got to put the whole package together. Okay. So Canada sees an all-time record for immigration. So on the flip side, see, this is why we put them all together. Might be a bunch of Canadians who are heading out of Dodge, but then there's a bunch of individuals who are coming in. Oh, but are they? Now, this is where, unfortunately, I've got some little bit more not so great news, because in Q4 2021, the government said, hey, it was an all-time record for immigration since 1946. Amazing, amazing. 405,000, 750,000 immigrants, highest recorded ever. However, unfortunately, and I've already shared this with you folks, but in a different way, because this keeps coming up. This is just from March 30th. So this news keeps getting repeated, and they don't get into the details. So you might be seeing it, and you need to understand that this is a headline alert, because these particular stats, just going back here, these particular individuals, the majority of those 750,000 immigrants were already in Canada. So it's a change of status primarily, not new immigration. Now that's okay, because by changing status and giving them permanent residency, it does positively impact our activity, our GDP, because people can actually go out and work. So immigrants can now work and make money, and that's good. But for real estate investors, it really doesn't make a huge immediate impact, because they were already here. They already had a place to live. So it makes little impact on rent demand and our rates and rental rates and real estate prices. So the Atlantic, why U.S. population growth is collapsing. This was really interesting. Very interesting. So in 2010, stagnant. 2020, lowest population growth ever. 2021, grew slowest pace in history, only adding 393,000 people. So we're not seeing a lot of growth in the U.S. either. And this particular individual who wrote this article, Derek Thompson, he says that a country that stops growing is a zero-sum country. That there's not enough immigrants. There could be misunderstanding, like in terms of why are they doing it. They, being the government, doing it on purpose in terms of not getting as many immigrants as they need. Could be a misunderstanding of basic economics. But in his opinion, America has steered itself into the demographic danger zone by not building and not growing as a nation. He goes through a whole slew and list of reasons why governments and countries need to be growing in order to have rights and freedoms and democracies and economic output and lifestyle, all of these things that you do want to have. So then I got into it. And I'm not going to go into all of this, and I can see this on here. I'll just go into this one, which is that is the World Migration Report from 2022. So this is a 40-page, I think, report that just came out from the UN, basically from their migrant department. And when we think about population, even notwithstanding all of that, the U.S. and currently Canada as well, and I'll show you a stat a little bit later, the U.S. attracts migrants. And so as long as the U.S. is accepting people, it seems as though they will come. And this is positive for rents and properties. And so based on this data that just came out, the United States of America has been the main country of destination for international migrants since 1970. That trend is unlikely to reverse. Things can happen without question, but it's a trend that's well entrenched. I mean, since 1970, I'm not even going to say how long that is, because was born in the 70s, late 70s. So when we look at the people, we're kind of more at a little bit stagnant, a little bit flat. We don't know. The data has to come in for this year. We're watching it super, super closely. Now, interest rates. We promised that we would talk about interest rates. Bank of Canada, what you need to know, and how, is anyone else feeling a little nervous about interest rates? Just pop it in the chat. I see a couple. Yeah, Anita. Okay. All right. Cool. Got it. Thank you. All right. So that's gonna happen. So here's what the Bank of Canada is got going on here. So the Bank of Canada increases policy interest rate by 50%. You guys are 50 basis points. It was April 13th, so in case you missed it. So the rate is now up to 1%. More to come. There will be more interest rate hikes. And now, just so you know and you're informed, you're going to start hearing it all over the place now. We've moved from quantitative easing and into quantitative tightening. So now here comes as we deflate that inflation. So here's your interest rates. But a lot of the questions are how much and how long. And if you guys, I'm going to talk about this in a moment, but if you know Daft Punk, anybody know Daft Punk? Some of the songs. We're into pop culture. Yeah, Lewis. All right. So this is a 2009 song. You can start thinking about it. That completely applies to how much and how long that's happening here. So here's the charts for you. If you need them, we are definitely moving up quite a bit. And how much? So BMO, they estimate another rates to be 2.25%, and which is obviously up a lot from where we've been. And in 2023, a lot of folks are expecting it to hit 4%. But the good news is that it is still below most stress test levels. So that's something to consider as a possibly positive. But here's another narrative that's going on out there. How COVID variants affected mortgage rates in Canada. I mean, these are actual stories and actual headlines. And I just want to say, can we talk off the record as friends? Is that cool? Let me get into this one. No virus has impacted interest rates ever. So when they start getting into your head that the COVID variants have done this, this is just the type of sensationalism. It's getting us further away from critical thinking than we need to be. And so when we think about, okay, let's take that mirror and shine it where it needs to be. It's not on the virus, it's our elected lawmakers, otherwise known as politicians. They're lawmakers impact interest rates. Yeah, I can, clickbait, exactly. But the thing with clickbait is it starts to train our brain to go, oh yeah, of course, yeah, the virus impacted my mortgage rate. It didn't. I see a lot of you nodding your heads. So thank you. That really helps me know we're on the right track. So mortgage rates for the U.S. Similarly, mortgage rates are up all over. And here we get into again, still faster, higher. And this is where your mortgage rates are brought to you by Daft Punk. You know the song? Harder, better, faster, stronger. Okay, I can't sing it, but I was going to include it in here. And I thought, oh no, copyright. But this song. So what does that mean to us as real estate investors? So this applies to Canada and the US. It means buy, and it does be mindful about buying sooner rather than later to get ahead of the interest rates. That is not to say that you should go out on a buying spree and be less prudent than you need to be. Still be strategic, and don't worry, a great property, even with high interest rates, will work. It just will. And we'll figure it out together. We'll do co-ownership. We'll figure something out where it still makes sense. There's a lot of options in this room with this community, and I know that we'll be able to figure that out. So you can take a picture of this slide. I know it's really busy, and I mentioned it last time too, but I want to really get this in here, is when we have all these crises, this crisis, that crisis, this crisis, and the governments, multiple, Canada, US, etc., print money, throw at it, we get into debt. That debt equals inflation and interest. Inflation up and interest rate up. And this is happening, and it's rinsing and repeating. And as long as we continue in this cycle without, remember, I showed the picture of stop digging? We got to stop printing, stop getting debt, and that is one of the ways, that's really the only way other than, of course, increasing interest rate. But at some point, you have to stop printing and circulating the money. Just saying. More on that in just a moment. So, this is what I wanted to say. Yes, I got it. So interest rates are rising, inflation running up are in fact buy signals, and do get those mortgages sooner rather than later if you can. But no pressure. Absolutely no pressure. So in regards to inflation, one of my favorite topics. How's everyone doing? Is this good? Are you excited for some inflation TNT? Oh yeah, thank you, Q. I appreciate it. As I've got some humdingers for you, Catherine. Yes. Oh, Eric has a question. Eric, does that mean we should get a fixed rate mortgage? Oh shit, dude, I have a whole section on that, but I didn't include it. It depends. And I would. How can we do this? Maybe someone could help me, and I'll just do a little like live something at some point, because I've got the slides. And the short answer for that is not necessarily. And basically the statistics, if you actually work the math, it's something like an increase of rate of like, I should have kept it in, of about like 1% or whatever. The actual material impact on your property and on your actual mortgage is like $100 a month or something. It really is not when you start to impact it. And then when you look at variable rates versus fixed rates, typically variable rates have a far better opportunity over the long term, until of course at a certain point, but we're still really at historically low rates. The two caveats is that if a fixed rate really, really helps you sleep at night, and you know beyond a shadow of a doubt that you are going to keep that property for like forever, for the entire mortgage term, then maybe consider it. But there are very high penalties for fixed rate mortgages if you happen to, and I did that once. I screwed up. I wanted to test it. It was really, really low anyway, a fixed rate mortgage. I thought I was going to have this damn property for like forever. I just did. And then instead, someone came in and offered me a ton of money for my entire portfolio in this particular region, and that one happened to be kept in it because that was part of the portfolio. So as a result, I ended up having to break that penalty, and it was really, really high. And so not necessarily the best decision on my part, but why I'm telling you that story is because sometimes things change and you don't expect them to. So I do like to have variable, and if things start getting too crazy, we'll keep you we'll keep you apprised of that. All right. And yes, Tammy, historically variable always is lower, longer term. Concur. And there we are. Okay, so inflation. My favorite topic these days. All right, Bank of Canada. So again, with their monetary policy report, April 2022, all the factors of economic and employment and all these things are going on. But holy crap. So this is what I looked up. It's got the report, obviously, but there's also this particular section of their website to have this in brief. And at 2 seconds, has anyone ever played the game America Says or watched it? It's like a game show, like Family Feud. America Says? No? Okay. Thanks, Allison. I appreciate it. Okay. So listen, I don't like it, but it's a funny little game that people play, and it's on, syndicated television, whatever, like Family Feud. And in our marketing this week, some of our marketing team thought it would be cute to say, hey, are interest rates making you soil your pants? And I said, that doesn't really jive with my professionalism. Maybe you could edit it. And they're like, you know what? But it's kind of catchy. I'm like, you know what? The minute I started seeing that and going through all this inflation stuff, I said, you know what? Well, inflation and interest rate. You know what? This is soiled my pants. This is crazy. So what is not okay with this is I've circled it in red. And that is that the supply. Hi, Christian. All right. Thanks for that variable or fixed mortgage. Thanks. So the supply chain disruptions are adding to inflation. And that's at 2 seconds in on a 1-minute video from the Bank of Canada. supply chain disruptions, inflation. This is from our governor, like the actual governor of the Bank of Canada. Right on. So this is supply, and so this is actually from the report itself. This is a table that's showing the impact of Russia's invasion on Ukraine on inflation. Everything listed in that channels section is supply and demand 101. It has nothing to do with inflation, and yet they're showing it. Oh, it's impacting inflation. I'm just like, I'm absolutely flabbergasted. I'm absolutely shocked. This is freaking me out, to be quite honest. And it should to us too, because this is our livelihoods and our tax dollars and all that in being overseen by these folks. So supply shocks are not inflation. I did a whole longer segment on it in January, but essentially it is a mistake to consider this. It is simply not true. And if it's not monetary, if it's not spending money during a recession, spending and printing money during basically lower economic times, it's not inflation. That's it. So lots of other individuals who are out there do see this. It is around. But then at 10 seconds, back to the Bank of Canada in brief report. All right, I made it to 10 seconds. I really did. I'm not even going to say what PMP is. I don't even remember, but I'll tell you that last one. Inflation is projected to stay well above our control range through this year and come back down to 2.5% next year. So this last little thing is and prayed up, which means, oh my goodness, we need help. So when we look and unpack the Bank of Canada's policies, yes. So I pooped my pants, and I gotta tell you, best one yet. So why? Because what I'm so excited about is all of you here in this community, our Real Estate Wealth Lab, is that with just these two insights coming up next, but you already know them, you are actually more qualified to implement national monetary policy. Hurrah! So you are definitely in the upper echelon in this country and definitely outsmarting them. So monetary policy, yes, you're more qualified. Again, supply chain disruptions are not inflation. Printing and circulating money is inflation. The international crisis, yes, it could impact, it could exacerbate inflation, but the only reason it's not supply chain, it's because they're printing more money and getting into more debt. And remember, that debt clock is broken. How convenient. So if you want to dive into more, please log into the member portal. Our January 2022 research lab, the inflation section and even the labor shortage section are very, very good and very thorough. And when you do that, and after having been here with us today, you will literally be able to change the world. And I'll show you how. So a little bit more from the Conference Board of Canada. So again, there's light out there. Others are seeing it. Why? Not the Conference Board of Canada itself, but because it surveyed a whole bunch of businesses. And in these businesses, thank goodness for common sense, these businesses are showing that they're having, well, unfortunately, decreasing economic optimism. So conditions might 71% conditions same or worsen. Okay. This is how you actually get out of an inflationary situation. So we do have to be mindful of that. And in 2022, annual inflation expectations, 67%, 5%. Certainly that is way higher than what the experts told us was going to disappear. And I will remind you of that in just a moment. And 17% of just normal businesses, that's you and me, Canadians, 8% inflation this year. So another one that we're very excited about, the New York